Yeah, the biggest difference that I was thinking about with that is that with multifamily, it's a lot easier for you to be your own property manager. But with this, it's a lot harder. There's a lot more red tape, government regulations, everything else to self-operate one of these senior housing facilities. The expenses are also a lot higher too, you know?
You got higher expenses, and the thing with these people who care for your residents is there's generally a lot of turnover, and so you're also having to rehire people, you're having to train new people, and so that greatly increases your expenses. So if you can find an operator who is good to their employees and gives them the time they need and everything to deal with their own stuff, because dealing with their own stuff, then coming in and dealing with somebody else's stuff, I'm sure takes a toll on anybody doing that, which is probably why there's high turnover. You get a good high morale and a good community or environment for the employee to thrive. I think that will help keep it down.
Welcome to the Ironclad Underwriting Podcast, where precision meets performance in commercial real estate. I'm your host, Jason Williams, and every week we deep dive into the strategies and systems and stories behind rock-solid underwriting. Whether you're a seasoned analyst, an up-and-coming investor, or a commercial real estate professional looking to sharpen your edge, this show is your front row seat to expert insights, emerging trends, and real-world underwriting tactics that stand the test of time and scrutiny. From market assumptions to debt structuring, cap rates to cash flow, we're cutting through the noise and getting to the numbers that matter. So sharpen your pencils and fire up those models. Let's get to work. This is Ironclad Underwriting.
Hey everybody, welcome to this episode of the Ironclad Underwriting Podcast. I'm your host, Jason Williams, and I got my good friend, business partner, co-host, I don't know, what else are you, Frank?
That's a good list.
So, how are you doing today?
Oh, pretty good.
But this I think will be our final episode on this little mini series of senior housing. So we'll do maybe a little bit of a recap and finish it off. How does that sound?
Sounds great.
Okay, so before we started off this mini series with an interview with Rod Cleef, which is your mentor, and he's like getting really heavy into senior housing. So I recommend everyone listen to that episode. I think it was maybe 4 episodes back, and then we start deep diving into the topics that he briefly touched on. And so that's where we are now. And this is the final episode. So ultimately what it boils down to, like multifamily property management can make or break a deal. The operators or the management company can make or break a senior housing facility. So
the biggest difference that I was thinking about with that is that with multifamily, it's a lot easier for you to be your own property manager. But with this, it's a lot harder. There's a lot more red tape, government regulations, everything else to self-operate one of these senior housing facilities.
Yeah.
But the expenses are also a lot higher too, you know?
You got higher expenses, and the thing with these people who care for your residents is there's generally a lot of turnover, and so you're also having to rehire people, you're having to train new people, and so that greatly increases your expenses. So if you can find an operator who is good to their employees and gives them the time they need and everything to deal with their own stuff, because dealing with their own stuff, then coming in and dealing with somebody else's stuff, I'm sure takes a toll on anybody doing that, which is probably why there's high turnover. You get a good high morale and a good community or environment for the employee to thrive. I think that will help keep it down. But yeah, definitely.
I mean, that's standard everywhere, right? I mean, the average person doesn't leave a job because of pay. I mean, they might think about it, but they may mainly leave a job because of bad management.
Yeah.
My theory, anyway.
No, that's true. No, that is true. But I think here you get higher turnover probably than normal, just because of everything that people have to end up going through. So,
yep.
But so that brings us to the next question of, how do you buy one? Where does the money come from? Is it just like a multifamily where you can just go and syndicate it and you go out and get a Fannie Mae and Freddie Mac loan and everything's hunky dory?
I'm sure it's not easy. If it was easy, then everybody would be doing it.
Yeah. But generally speaking, I believe you can syndicate senior housing, assisted livings, very much like multifamily. And you can get Fannie Mae and Freddie Mac agency loans. I do not know what the requirements are for those because I've never tried to get one. But if they're anything like multifamily, I'm sure there's a lot of hoops you're going to have to jump through to get it. Like for
You probably need
multifamily,
someone on the team or already have an operator that is going to work on it. I mean, the average company is not going to give you a loan if you have no experience and you haven't worked with an operator at all.
yeah, like when we've tried to get Fannie Mae and Freddie Mac loans in the past, we had to have an operator who has experience. What was it, 3, 4, 5 years of experience or so? They had to have experience in that specific market. So I think we've talked about this before. Wichita Falls, which is an hour and a half to 2 hours away from the DFW market, is not the same, and they would not count a sponsor who has deals in DFW for a Wichita Falls deal. Now, granted, the agency just doesn't like Wichita Falls. It's a smaller market and a small balance loan, and so we have a lot of things going against us in that regard. And I imagine with senior housing and assisted living, you probably would face some of those same regulations and restrictions as well. All the red tape that we faced. So,
I mean, like you said, like multifamily, there's a lot of options. There's HUD does offer 20% down. If you go to a regular bank, they probably will be a 35% down or a 65% loan to value. The closing would probably be faster than HUD. And there's also bridge loans and tons of other types of ways to get money.
yeah, HUD. If your HUD for multifamily is really only good for like newer properties. And so with HUD, with a multifamily, you have to have like everything up to date. Everything that's been grandfathered in code wise now has to be brought up to current code, not grandfathered in anymore. So a lot of expense in putting into like older properties. So HUD might not be an option, but HUD also is more of a refi option than a buy option, just because it could take up to like almost a year for it to close. So you typically want to close fast with a bridge and then do a HUD or something like that. Maybe.
We also have longer term amortization deals too.
Yeah, HUD, you can get loans amortized up to 35 to 40 years.
Yeah.
And
versus a commercial bank, which usually wants a 5 to 10 year loan and a 25-year amortization. Or 20
yeah, but with HUD, it's also amortized for 40 years, but its term is 40 years, and they have hella high prepayment penalties if you try to refi or sell and the person buying doesn't assume. So
I know on SBA, if you have to have an operator, if you're an operator, you can get it 10% down, 15% down, stuff like that.
Okay. Bridge, we've talked about these loans before, but how they apply to senior housing is almost identical to multifamily. A bridge, it's going to be a shorter term, maybe like 2 to 4 years. It's going to be interest only, higher interest rates. And again, bridge loan is just to take you from like purchase to bridge you into a longer term debt, like agency debt or HUD. Sometimes you can get bank loans that'll do longer than 5 years. You can maybe get a 5 or 10 year bank loan. A lot of commercial loans that I have with banks, they go on like indefinitely, but they change rates every 3 to 5 years or so. So that's the debt side. The equity side is you partner, JV, come up with cash on your own, or you can syndicate it just like an apartment complex. So. And if you're going to syndicate it, if you go by what we talked about with Rod Cleef, your returns are generally going to be better than multifamily if it's run right. So where he was talking, what, 20+% IRR, if I remember correctly.
Yeah, I mean, if you're buying the right deal, where he says it's the best deal he's seen in a long time, if you pick up a heck of a deal, then yeah, you can definitely do well on it if you have the right operator and if everything goes according to the plan.
Yeah. So anything else on where the money comes from? REITs, you're not going to generally do, you can, if you invest in a REIT, you're investing in a REIT kind of, I don't know if we've ever really talked about REITs before.
Sounds like a possible episode.
Yeah, but it's my understanding, and I've never invested in a REIT. It's like almost like a stock for real estate. You don't get any of the depreciation or tax benefits of like actual buying the real estate. But you put your money, you buy the stock, and then that stock goes and that'll buy the property. So generally speaking.
So Jason, as a smaller investor just getting started in this, what do you recommend?
I recommend listening to these episodes and then doing your research and homework even further than what we've touched on. I would recommend going out, meeting people who actually do these investments to senior housing, maybe partnering with them. I know people who are helping raise capital for assisted living. I was talking to a guy yesterday. He was actually putting an assisted living model through my Ironclad app, and I was helping him figure out how to do that. And actually, we were able to get it to work for what he needed it to do. So, but there's people out there, and he's helping raise money for a group. He's not actually going to operate it. He's never done one before. He's partnering with a GP who has done them before, and that GP has their own, I guess, operating group, or they know how to find a good operating team to run the actual facility. So that's what I would recommend, is partner with somebody who's done it before. Find a mentor.
I agree with that concept. No matter what, on the first one, I would start on the smaller side. I mean, if you see a brand new build that they're selling in your market, you're not necessarily going to jump in and buy that. If you do, I mean, you're competing against some pretty big names, some people with a lot of money. If you do something a little older, a little smaller, get your feet wet sometimes, that might be the best play. Even with a partner, even if the partner's done one or two deals, if you do something a little smaller.
Yeah. If yes, but the big players also need people to help them, and they're looking for partners all the time. And so if you can get on with one of them, then that would be a good way to get your feet wet. It's not going to probably take too much of your time, because you won't be bringing too much to the table yet. But you will see how the bigger operation runs. Does that make sense?
So, definitely. I'm just trying to say stuff like, there's a myth that you need to be huge to invest in this type of space.
Yeah. So no, you don't need to be huge. You can start out small. But I would definitely find a mentor who is actively investing. We have talked about mentors in the past. We highly recommend them. You have one, I have one, or you have many and I have many. So it's definitely worth getting a mentor. And even if it's the person doesn't like want a mentor, I know a lot of people who I've met at like RIA's real estate group meetings and stuff like that, who just want to help people. They want to tell their story all day long and how they did this and how they did that. And if you actually pay attention, you take them out to lunch and let them talk your ear off, you will get a lot of good tips and tricks on how to run or how to invest in real estate, senior living, stuff like that. So
yeah, I mean, some of the important numbers, at the beginning, we talked about this, 10,000 people a day across the whole country, but that's a pretty big and important number. It shows that the demand is going to be around for a little bit of time, especially when we are there is not enough of this type of property out there. So I wouldn't say the returns are guaranteed in any way, especially if you overpay for it, especially if you mess up on operations. But the demand for the housing is definitely out there.
Yeah.
And then yeah, that's all I got on this.
Yeah, I was going to say this. I think, and it's a wave. We're catching it on the wave, but in 20, 30 years, when all the baby boomers are 95% gone, then the demand might not be as high, but this would be more of like a 5-10 year hold plan versus a 30 year or like legacy type hold, I would think. I could be wrong. I don't know what's going to happen in 20, 30 years. Who knows? Maybe all these microplastics are going to make all our Gen Xers so old and decrepit that they won't know what to do. So
I was going to say maybe I'm going to live to 130, but that's the opposite. That's being positive versus your negative concept.
No, I'm not. I'm saying they could live to 130. If they live to 130 and they're in a facility, they got in the facility, and when they were like 70, then guess what? You've been in that facility for 60 years.
Yeah, that's crazy.
So when you exit, another myth is cashing out means you sell everything, or there's several types of exits you can do. You can sell to a REIT, you can refinance and hold, or you could sell it if you have like a portfolio of them, you can sell them as a portfolio. You could potentially change the lease up type. You can say, all right, we'll get rid of like the operations. We'll let someone else handle that. And we just want to do like a triple net or something like that and just rent out the building. So, I mean, there's different exit strategies you can do. And when you're underwriting, you want to know what your exit strategy is when you create your business plan. But we've also talked about exit strategies in a previous episode where your exit strategy has to be somewhat fluid just because you don't know what's going to happen in 3, 5, 10, 30 years. So you can't just say, all right, this is our strategy, our business plan, this is our exit strategy, and we have to hold to it no matter what. And that's what we're going to do. You have to be somewhat fluid in that regard. So
definitely.
Anything else on senior housing or assisted living?
Not necessarily. Definitely are placed for opportunity.
Definitely. And as I mentioned before, I am going to probably try to find a mentor myself, get deeper into it, get deeper into the actual, like create an underwriting model for it, tie it into my Ironclad app, and also look out for the free resources that are going to be in my vault on my ironcladunderwriting.com website. So you know how to reach me. All my links are in the show notes. Ironcladunderwriting.com has everything. Frank, how can people reach out to you?
I'm around. Just type in Frank Patalano on most places. You'll find me.
And I don't know. I think we put in some of Rod Khleif's links in his guesting episode. We can probably put out some more in this episode if you want to reach out to him. He did say he's not going to be doing a boot camp for assisted living in the immediate future, but it's probably going to come down the line. So that would be something to look out for as well. So, and we'll catch you next time. Bye. And that's a wrap for this episode of the Ironclad Underwriting Podcast. If you got value from today's conversation, make sure to subscribe, rate, and share the show. And don't forget to connect with us on LinkedIn, YouTube, Facebook, Instagram, or check us out at our website at ironcladunderwriting.com for more insights and updates. If you have a question, a deal you're analyzing, or a topic you want us to tackle, shoot us a message. We'd love to hear from you. Until next time, keep your assumptions grounded, your models sharp, and your underwriting ironclad.